What if I told you the stock market is not designed to make you rich quickly, but to quietly transfer money from the impatient to the patient? Most people believe the market is unpredictable, risky, and controlled by insiders. They think investing is gambling only for experts, or something you start when you already have money. Yet the same system that wipes out beginners has, over decades, created more millionaires than any other wealth tool in history. So what is really going on here? Why do markets crash, recover, and then crash again? Why do ordinary people keep buying at the top and selling at the bottom? And why do the same mistakes repeat every generation, even though the data is public and the lessons are well known? To understand investing, we have to stop looking at charts first and start looking at human behavior, setting the stage what the market really is. Before apps, before green and red candles, before YouTube gurus and viral stock tips, the stock market had a simple purpose. In the early 1600s, merchants wanted to fund risky but profitable voyages. Ships were expensive. Voyages could fail. So instead of one person taking all the risk, many people pooled money together. If the voyage succeeded, everyone shared the profit. If it failed, the loss was shared too. This idea gave birth to public investing. Over time, companies replaced ships. Shares replaced handwritten contracts. Stock exchanges formed to make buying and selling easier. And one powerful idea took root. When businesses grow, investors grow with them. But there was a hidden twist. As markets expanded, speculation grew faster than understanding. Prices began moving not just on business performance, but on fear, greed, and stories people told themselves. And that's where the trouble began. Origins: how investing became speculation in the early days. Investing was slow and boring. You bought shares, waited years, and collected profits. But humans don't like slow. The first major lesson came in the 1600s with the Dutch tulip mania. Prices rose simply because people believed prices would rise. Tulips became more valuable than houses. Then, suddenly, confidence broke. Prices collapsed. Fortunes vanished. The pattern was set. Every bubble since then follows the same cause and effect chain. A new opportunity appears, early investors' profit stories spread. Prices detach from reality, newcomers rushing, confidence breaks, panic sells everything. The stock market didn't change. People didn't change either. The rise, modern markets and easy access, fast forward to the 20th century, industrial growth, global trade, and technology exploded. Stock ownership expanded beyond elites. Indexes like the Dow Jones and S&P 500 were created to track overall market health. Here's the critical shift. The market stopped being about individual companies and started being about expectations. Investors weren't just asking, is this company good? They were asking, will others pay more later? This fueled massive growth. Long-term investors who stayed calm through wars, recessions, and crashes saw extraordinary results. Over long periods, markets rose not because of magic, but because businesses kept producing value. But with growth came a dangerous illusion. that markets only go up. The breaking point when confidence snaps, every major crash begins with confidence. The Great Depression, people borrowed money to buy stocks, prices soared. Then earnings slowed. Selling began. Panic followed. The market collapsed, not because businesses disappeared overnight, but because belief did. The dot-com bubble. Companies with no profits, sometimes no products, were worth billions. When reality caught up, prices fell over 70% in some cases. The financial crisis, housing prices were assumed to be safe forever. They weren't. Leverage magnified losses. Banks froze. Markets plunged. In each case, the cause was not complexity. It was simply overconfidence, excess leverage, ignoring history. The effect was always the same. Fear replaced greed. Fallout: who really loses? Here's the uncomfortable truth. Most losses in the stock market are not permanent. Markets recover. Companies adapt. Indexes climb again. But many people never benefit from that recovery. Why? Because they sell at the worst possible moment. Data shows that the average investor consistently underperforms the market, not because of bad investments, but because of bad timing. Buying after hype, selling after fear. The market punishes emotional decisions, and every crash transfers wealth from panicked sellers to calm buyers. Failed fixes. Why most strategies don't work after every crash, new solutions appear. Market timing, hot stock tips, complex trading strategies, predictions based on headlines. They all promise control. But study after study shows most professional fund managers fail to beat the market long term. Not because they are unintelligent, but because predicting short-term movement is nearly impossible. The market is influenced by economic data, interest rates, global events, human psychology. Trying to outguess all of that consistently is a losing game. The failed fix is thinking investing is about prediction. It isn't. Modern parallels the pattern repeats today. The same cycle plays out in new forms. Social media accelerates hype. Zero-commission apps remove friction. Trends spread in minutes, not years. Retail investors rush into assets after massive gains. Influencers show profits, not losses. FOMO replaces analysis. And yet, the data remains stubborn. Long-term diversified investors win. Short-term emotional traders lose. Market volatility feels new, but the pattern is ancient. Different assets, same psychology. The real purpose of investing is not about excitement. It's about ownership. When you invest, you are buying a piece of productive human effort. Factories, software, services, innovation. Over time, productivity compounds. The market rewards. Time in the market, diversification, discipline. It punishes impatience, leverage, emotional reactions. This is not accidental. It's structural. 3 clear takeaways. First, the stock market is a reflection of human behavior, not a casino. Understanding psychology matters as much as understanding numbers. Second, long-term investing works not because markets are easy, but because patience outlasts volatility. Third, most people fail not due to lack of information, but lack of discipline during fear and greed cycles. Warning: the open question. Here's the warning. The market will crash again. Not because something is broken, but because that is how the system resets excess confidence. The question is not if, but how prepared you are when it happens. Will you panic and sell, or stay invested and let time do the work? History already shows which choice wins. Call to action. If you want to understand money instead of reacting to it, stay curious. Learn how markets actually work, not how they're hyped. If this video helped you see investing differently, like the video, subscribe for more deep, clear explanations. And share it with someone who thinks the stock market is just luck.